Welcome to This Explainer. Look, I want you to completely forget everything you've ever been told about Wall Street. Most people think investing is an exclusive country club. They think you need thousands of dollars saved up just to get a seat at the table. They picture financial advisors on speed dial, complicated charts, and some secret insider knowledge that only the ultra-wealthy have access to. Well, I'm here to aggressively tear down that myth right now. You absolutely do not need a massive bankroll to start building real wealth. If you've ever looked at the stock market and thought, man, that is only for the rich, I really need you to hear this. The barrier to entry has never been lower in the entire history of investing. The apps exist, the tools exist, and the information is literally right in front of you. You can start investing today with as little as $100. In some cases, $10. In some cases, literally $1. The only thing standing between you and your first investment is simply the decision to start. You are financially capable of doing this, and by the end of our time together, you'll know exactly how. Section 1. The Wealth Barrier Myth and Why Small Amounts Matter. Let's look at the massive, absolute cost of not investing. Before we get into exactly how to start, we need to quickly talk about the why, because understanding this mathematical reality will permanently change the way you look at even small amounts of money. Your money is doing something right now, or rather, it's doing nothing. If you take $100 and just let it sit in a regular bank savings account earning a pathetic 0.01% interest, it will be worth about $100.10 after an entire year. It is essentially doing nothing. Now, contrast that with the exact same $100 invested in a low-cost index fund tracking the stock market. Historically, the market returns around 8 to 10% per year. With a grounded respect for how markets actually work, that means your money doubles roughly every 7 to 9 years through compound growth. Your money actually goes to work for you. Now, let's look at the true magic of compound growth over a long timeline. Let's say you take that initial $100 today, you put it in the market, and then you decide to add just $50 every single month. That's it, $50. Assuming an 8% average annual return over a 30-year timeline, I want you to really think about what that quiet, boring contribution turns into. Over $75,000. That is not magic. That's just math. And it works exactly the same whether you're investing $100 or $100,000. The underlying principles do not change. The people who build wealth aren't necessarily the ones who earn the most from their salaries. They are simply the ones who start the earliest, even with small amounts. Section 2. The blueprint and exactly what to invest in. Let's completely remove decision paralysis right now. The math makes sense, but this is exactly where most beginners absolutely freeze. There are thousands of stocks out there, so we are going to completely remove that paralysis right now by presenting a curated, incredibly obvious menu of what to buy. You don't need to be smart, you need to be consistent. If you don't know where to start, you start here. An index fund is simply a collection of stocks that tracks a market index. The most famous is the S&P 500, which contains the 500 largest companies in America. When you buy into an S&P 500 index fund, you're essentially buying a tiny, diversified slice of hundreds of companies all at once. This brilliantly eliminates the need for stock-picking expertise. Instead of trying to guess which individual company will win, which, let's be honest, even professional fund managers struggle to do, you are simply betting on the overall growth of the American economy. And you don't just have to take my word for it. Warren Buffett famously said, for most people, a low-cost S&P 500 index fund is the single best investment they can make. That is the ultimate endorsement from arguably the greatest investor of all time. This is the boring strategy that actually works. Over long periods, this simple strategy has historically outperformed the vast majority of highly paid, actively managed funds. Now, alongside index funds, you'll probably hear about two other options for beginners. First are ETFs, or exchange-traded funds. They're very similar to index funds and offer the exact same diversification, but they trade on the stock market like individual stocks throughout the day with very low fees. Many ETFs can be bought for under $100. Then there are fractional shares. These allow you to buy tiny pieces of corporate giants like Apple, Amazon, or Tesla for as little as $5 or $10. It is a great way to learn how stocks work. But for your very first $100, the default obvious choice is always a low-cost S&P 500 index fund or ETF. Section 3. The vehicles and choosing your platform. Let's look at the exact apps you can use to transport you to your future wealth. I want you to stop looking at investing apps as intimidating, highly technical financial terminals. They really aren't. Let's walk through this curated list so you know exactly which default option fits you best. First up is Robinhood. This offers ultimate simplicity. no commission fees, fractional shares from $1, and an interface that just won't overwhelm you. Next is Webull. It's very similar to Robinhood, but gives you better analytics if you want to dive into the data as you grow. Then there's Public, which brings a social investing aspect, letting you see what others are buying. If you want a deeply trusted traditional powerhouse, choose Fidelity. They offer zero-fee index funds and allow you to open a tax-advantaged Roth IRA with no minimum balance. Finally, there's Acorns. If you were totally passive, Acorns simply rounds up your everyday purchases and invests your spare change automatically. Pick the one that sounds like you, and you can always check the link in the description below to get started right now. Section 4. The execution, a step-by-step guide. I'm going to hold your hand through a zero-friction walkthrough. This is the moment where most people either take action or click away. We are going to look at the exact buttons to press so that making your first investment feels as embarrassingly easy as ordering food online. Here is your 6-step checklist. Step 1, choose your platform from the list we just covered. Step 2, open your account. You download the app, verify your ID. It literally takes 5 to 10 minutes. Step 3, link your bank and deposit that first $100. Step 4, search for a low-cost S&P 500 ETF. Step 5, tap the buy button and enter $100. And step 6, the absolute most crucial one, go into your settings and set up recurring investments. Literally just tap the screen, follow these 6 steps, and you are completely done. Now, back in step 4, I told you to search for an ETF. Let's completely eliminate any anxiety over what to actually type into that search bar. When you open your chosen app, you'll search for a ticker symbol. You can choose VOO for the Vanguard S&P 500 ETF. You can choose SPY for the SPNR S&P 500 ETF, which is the most traded ETF in the world, or you can choose IVV for the iShares Core S&P 500 ETF. Look, if you're stuck and don't know what to pick, just type in VOO on Fidelity. Done. While you're looking at those funds, you'll probably see a piece of financial jargon called an expense ratio. Let's casually define this right now so you aren't caught off guard. The expense ratio is simply the annual fee charged by the fund. Lower is always better. For example, a 0.03% expense ratio means you pay exactly 30 cents per year for every $1,000 you have invested. That is almost nothing, and that's exactly why choosing these specific low-cost funds is absolutely crucial. And remember step 6, setting up that recurring investment? There's a technical term for this. It's called dollar cost averaging. By setting up an automatic weekly or monthly investment, even if it's just $20, you buy shares regardless of whether the market is high or low. This is the single most powerful habit in long-term investing because it automatically smooths out market volatility. You buy more shares when prices are low and fewer when prices are high without ever having to even think about it. Section 5, the guardrails, and avoiding these beginner traps. Now, I really need you to lean in and listen closely to this part. Knowing what to do is important, but knowing what to avoid is what actually keeps your wealth intact. I have personally watched people lose thousands doing this. Number 1, do not try to time the market. Nobody can consistently predict short-term movements. Time in the market beats timing the market. Number 2, don't panic sell. A 20% drop feels terrifying, sure, but historically, every single crash is followed by new all-time highs. Selling during a crash locks in permanent losses. Staying invested lets time fix everything. Number 3, don't invest money you're going to need in the next 6 months. Investing is for money you won't touch for years. And lastly, don't chase hot stocks. Crypto tips and meme stocks are just gambling. Stick to boring, diversified index funds and let compound interest do its quiet, powerful work. Section 6, the momentum. What happens after your first $100? Starting with $100 is really about building the habit and the knowledge. It is not about getting rich overnight. Most wealth is actually built in the quiet, simple, boring months of consistency. So here is your long-term playbook as your income grows and you gain a bit more confidence. First, make sure you reinvest your dividends. When your fund fees out a portion of its profits, roll that money right back into buying more shares. Next, slowly increase your monthly contributions as you earn more. And finally, if you are eligible, open a Roth IRA. The tax-free growth inside a Roth IRA makes a massive, massive difference over decades. I really want you to internalize this point. The first $100 is the hardest. Getting over that mental hurdle, picking a platform, hitting buy for the very first time, that is the absolute hardest part of this entire journey. Everything after that is just momentum. It's really just letting gravity and math pull you forward toward your financial goals. Once you've pushed past that initial barrier and your money is actually in the market, your identity shifts. You are no longer someone just looking at the financial world from the outside in. You are financially capable. You are now an investor. You officially own a tiny slice of the greatest companies on earth, and they are waking up every single day working to make you money. So I have a challenge for you. You have the exact step-by-step blueprint. You know the exact funds to buy. Which platform are you opening your account on this week? Not next month, not someday when you feel like you have more money. This week. Make your first investment, even if it's $50. Set up a recurring contribution, even if it's $20 a month. And then just leave it alone. Take that action today. Start building the quiet, boring, incredible momentum of compound growth. Put the math to work for you. Do this right now, and I promise you, your future self will thank you.